looking at that. They're all looking the other way.
But there is this great reset, and I'm really glad that we do have Jim Bianco on as we really not only look to earnings, but what this great reset in the yield space means for the broader economy. And Jim Bianco joins us now. He's president of Bianco Research. Jim, how much do you start to look at a 5% Fed funds rate next year and say, maybe that's not even enough?
Oh, I think that could very well be the case. First of all, as historical example is the 2-year yield always peaks above whatever the terminal rate is. So if the terminal rate's 5%, it should, before the cycle's over, go above that. And if the terminal yield keeps going higher, you keep resetting the 2-year yield higher. But it really comes down to inflation. Is it persistent? And let me be clear on persistent. Yes, there's signs it's peaked. And yes, there's signs that inflation is coming down. But if it stalls out around 3.5%, 3%, 4%, then these yields are appropriate. If it's on its way back to 2%, then these yields are too high. I do fall into the camp that we're probably going to see persistent inflation and that these yields are not all overdone, right. At least not yet.
Jim Bianco, all of us have lived the John Taylor Great Moderation. It's been decades. You and I remember 14% annuities, 10% double-digit yields, on and on and on. We don't have a collective experience of going the other way. What do corporate profits do if we move the other way to a higher yield regime?
Well, not only don't we have any experience going the other way, we have pretty much structured a lot of the financial market on the assumption that we were going to stay with low, stable rates, a great moderation economy, and no inflation. Liability-driven investing in the UK being the headline child right now, and there's probably more to come. I think that as we move forward, we're going to find that this is going to be an even tougher environment than people think. And I've been advocating something I've been advocated for a long time. This might be the return, to use the Wall Street term, alpha. This might be the return of stock pickers and bond pickers, as opposed to just buy an index and wait for it to go up. You have to pick individual companies that can survive this environment, because not all energy companies will do well, others will. And no one's really ready for that kind of environment because it's been so long since we've had to do it.
Jim, you were 15 years old when you were at First Boston. I mean, it was a few years ago, to say the least. But the bottom line here is the overlay on that is transactions and combinations. I would suggest merger 2023 may be the headline.
It could very well be, because with this new environment, there's going to be opportunities for companies to pick up other companies that are not positioned for it, and companies that will strengthen. You know, another Wall Street term is we're going to see the dispersion of returns be much wider than we've seen in the past. So it's not going to be enough to just, like I said, buy industrials. You got to figure out which industrials to buy. This is a big change from the last 20 years.
I understand that there is this sort of bond stock picker bias right now because of the new regime change in both yields as well as just a broader economic shift. However, I've been really struck by what's going on in the high yield bond space. It has been so resilient. People seem to be saying companies are just doing fine. They have a lot of cash. This credit cycle is going to be a lot different and a lot less dramatic than previous ones. Do you agree?
Well, I agree to some extent, because first of all, remember, the high yield space is largely a space of industrial companies, manufacturing companies, energy companies. Those are the companies that are doing well, where the stock market's more of a space of growth companies like technology companies. And when you get into the NASDAQ, unprofitable technology companies, those are the companies that are struggling. So that's definitely helping the high yield space. And the other thing is large nominal growth. When you have high inflation, these companies will see their bottom lines go up. Whether they can beat the inflation rates, another question, but at least their growth rates will continue higher.
Nice analysis, Jim, but what does that mean for bonds? If I'm a bond person clipping coupons, folks, for those of you younger, scissors, Bianco sitting there with, the electric company of Chicago clipping a coupon, bond people don't have that advantage of the bright lights of nominal growth that corporations have.
Well, that's right. For a bond investor, it's all going to be about rates, and it's all going to be about moving yields higher. Or, this is something new. We've got yields that we've not seen before, and I think we're going to continue to see it. And that should be the focus. And I think that's where the focus is on higher rates. Yes?
Well, no, but Jim, before we let you go, I'm curious about whether we see a lost decade in this kind of regime. I understand what you're talking about with respect to specific bonds or stocks doing well. But on an index level, are we going to see meandering returns for equities because of this fiscal discipline and higher rates that completely change the value proposition?
Yes, that's my fear, is that it's a post-pandemic economy that needs to change for the new world. It's a work-from-home world. The supply chain still needs to have some work. We still need to figure out what we're going to do with China. And for the next several years, it's going to be a complete restructuring of what we've seen. That means indexes sideways. That means yields higher. That means great opportunity within stocks and within bonds. Yeah, like I'm going to emphasize, that's not what it was in 2010 to 2019. So, yes, index is sideways, but there will be opportunities within it.
Jim Bianco of Bianco Research, thank you so much. And I kind of want you to stay here for what's coming because I can